Greetings, it's Dr. Jeffrey Scott, and this is my weekend market update for November 6, 2022. Sorry that this is being done so late, but I just got back to my Florida home from my New Mexico home, and I decided to wait until I return to do this. I title this, What Happens When the Fed Pivot is Bearish? And again, today's November 6, 2022, and my email address is hgsidoc@gmail.com. Disclaimer, this is for education only. Anything I recommend should be considered in the spirit of education and not investment advice. I am a doctor, not a broker. I am independent. Tools demonstrated are those that I use in my daily trading. I've paid for all these tools that I demonstrate. Trading involves risk. You are solely responsible for any investment decisions you make. Options are considered risky, and before you consider options trading, please get educated to the risk that you might be facing. This meeting is a go. Haven't had this in a couple of years since COVID came. I can tell you every time I've done it, I get energized and I get great feedback. It's a great opportunity to visit with old friends and to meet some new ones. It is Sunday, December 4th and Monday, December 5th. I limit it to 15 folks. I've got over half the spots are taken. All meals during the program, including snacks and beverages, event dinner Sunday Eve at Capitol Grill. I record everything from my desktop and I will send them to the attendees. I also will share with those before the meeting archived material from the last live events. And I have a number of non-proprietary, meaning I didn't pay a third party for them and for their intellectual property. Indicators for Toss and Trade Station I share. I've got some new things I'm going to be introducing at the meeting. Folks that came to the meeting that I did in Orange County earlier this year. I know there's been a lot of interest in a new scanning tool, but we'll talk about that at the meeting. Particulars on Sunday I spent a lot of time reviewing what I've learned from Ian and other masters, reviewing my favorite setups. I'm agnostic to platform. I don't own a platform. I don't make money when you pick a platform. So I try and make my tools useful across those platforms. Seasonality, I've already secured a guest speaker. We'll look at options, money management, how I find my favorite trades, and how I play earnings. You can fly into PBI. It's 20 minutes from where the meeting is, or Fort Lauderdale, which is 55, has more direct. If you have a guest, they can participate in the meals, but there's a fee. There's no online anticipated for this event. I charge $1,000 per person. When you consider the food and the what I provide, I think you'll find it's actually a bargain. You'll get more software and other things more valuable than the $1,000. If you're interested, email me at hgsidoc@gmail.com, and then I'll send you the link and more information. Again, we're about half full, and hopefully some of my friends that appreciate these programs that I do and the daily programs will show some interest and will fill up the meeting pretty quickly. All right. So let's just quickly go through my spreadsheet. And I started doing this for myself because it really forces me to look at what's going on in the market and to get an understanding of what works, what doesn't work, and what I might want to pay attention to. These are two views in HGSI. They're easy to set up. The first one is looking at 5 days behavior of the market. I've ranked them by how far they're off from the 52-week high. This is when those 52-week highs occur. You can see most of them were either at the very end of 2021 or the beginning of 2022. The most best performing entity in the last 52 weeks, no surprise, is the US dollar. What's interesting is the spider's down 12.3, the NYSE 15.7, not the spider, the diamond rather. NYSE is 15.7. The spider's down 21, so it's back in bear market territory. The 2000 is down 26.9, and the various NASDAQ indices are down about 35%. So this is clearly still a bear market. We could see on the week that the major indices were led, I guess you could say led least bad by the NYSE and the Dow, and the worst performers were the NASDAQ indices. Big cap tech really leading the way down to a great extent. Now, if you want to be bullish, you could look over here at the various major index symbols, and you could see the diamonds are up 13 from their June lows. Um, Actually, they set their lows October 2022. But for the most part, on closing prices on the weekly, the June lows have held. But the diamonds, the NYC, you can see where they are. The spider's up 8, IWM is up 10, and the NASDAQ really has not moved much off of the October 13th lows that we saw. If we look at the sectors, the leading sector or the least down is the energy and healthcare, and the worst would be technology, discretionary, and communications. Not unlike what you would expect in a bearish market. In the markets, if you just, as we looked at Friday's market, it probably doesn't tell the whole story because Friday was different than the rest of the week, and perhaps, well, to me, it was a bit of a surprise. You could see we ended with 74% of the stocks above the midline of their Bollinger Bands, which increased from Thursday. We can see that on Friday, 91% of the sectors advanced, 85% of the industries, 80% of the stocks. If you look down here, the only laggard was services, which has communication, which has lagged all year. You could see that there are stocks above the Bollinger Bands, but they've come down from where they've been the last couple of weeks. But if we look at the week itself, you could see that 82% of the sectors were down on the week, 65% of the industry, 61% of the stocks. So whatever exuberance you felt on the close Friday, that was one day of the week. That was good. The warehouse report up here, these are each week. The last week, the interesting thing is growth actually did better, as you could see. ERG, which is a combination of EPS rank, relative strength rank, and group rank, biggest score is 297. When I rank stocks by ERG and I look at the performance, you could see that the lower ERG stocks underperformed and the higher ERG stocks actually did better. We can see that relative strength rank, interestingly, except for the stocks that had no relative strength, improved as relative strength got better. EPS, you were less bad if you had earnings, but it was not a pretty week, even with this picture here of the head bouncing up above zero. Now, I look for the Hindenburg Omen. Just got some great indicators I'll share with everybody for TOS, for looking at the Hindis. I shared with everybody at my live meeting. Let me paraphrase that. But what you could see on the NASDAQ here, no Hindi Omen, which we wouldn't expect. You got to get back to highs. But the NASDAQ never broke the number of stocks with percent new lows worse than 2%. It did get some new highs, so there started to be some improvement in some parts of the NASDAQ. We ended up poorly, and we ended up with the bongo going red again. That's extremely disappointing because that weekly bongo is a key component of my, what I look at as my, what's what I want to use, weekly market timing signals. When I look at the NYC, it's a little prettier. We still had the red new lows the last 3 days of the market, but we haven't broken out of the weekly bongo green. So the NYSE, if you think about it, it's 3,000 plus stocks, probably behaving than some of the narrow indices like the NASDAQ 100, the IBD 50 ETF, the FANG stocks. So perhaps this broadening of strength, and you can certainly see here the number of new highs has started to increase, although still lower than the new lows. But that broadening might actually be a positive sign for the market and a silver lining. The buckets, as I showed you, most of the stocks are above the midline. This is where we were a week ago. You can clearly see how the markets have cooled some, and in fact 40% of the stocks were outside their Bollinger Bands, and I probably said something along the lines that we typically see the markets pause there, and you could see that we've come back in. This is what bad looks like, and this is from September 23rd, and when you see this pattern, you expect the market to go up. So this was a market that pretty much said we've probably run our time, and short term we need to pause, and this is a market where we've run our time to the downside. The oops just shows you that as much as when I see this, I get excited that a reversal is imminent, same as it was here. There are times like horrible bear markets, and we're in a bear market now, where you could go on. Here's a third, sixth, seventh, eighth, ninth, and 10th. So you had 6 days where the buckets actually got more and more profoundly bad. Um, and so they can get worse even when they're already showing what I call left shift. On the energy side, look at the weekly here, except for coal. It was a very good week in the market. Mr. Volatility, the natural gas was up this week, down on the month, really up a lot on the day Friday. This is volatile, it's so tied to what's going on in Ukraine. But you could see that energy was better this week than it was last. When you look at the metals, again, a lot of green here. The dollar had weakened a bit, and that helped gold and silver. Silver really outperforming gold, although from a year-over-year perspective, silver is underperforming. Copper picked up on the week, as did iron ore. But you can see the dry bulk index spot price continues pretty poor here, although it's off its lows. Now, what's driving the market? Well, it's interest rates. And you could see with thoughts of many that a pivot was imminent, there was an expectation that the markets might rally on a Fed pivot. But as you could see, the Fed, if they pivoted more bearish, which was sort of the point of the title. And the 10 and 30-year rates actually headed up on the week. I look here constantly to remind me that we are still in a 10-2 Treasury yield inversion. And when you look at history, this is going back to 85. Whenever we've broken below, we've had a recession afterwards. Below recession, below recession. Minimally below recession. Well, what do we expect is going to happen here? We have a recession coming, and people like to debate whether or not it's coming, and I guess I don't have a crystal ball, but just think about this. Bear market rallies do not end with rising rates. The second thing to think about is, why would the markets recover when we're facing a recession? So am I Mr. Bear? I guess I'm Mr. Bear right now. But the funny thing is, I've always been accused of being too bullish. So I'm hoping I'm wrong. I'm hoping that this market just goes to the moon, because I'd rather be bullish than bearish. But these are some of the points that have me extremely nervous about this market here. Tightening of the credit spreads. Yeah, we've come off the highs. That's awesome. And, this was 2020 before the market rolled over. This is 2018 going into 2019, and look what happened in 2019. So I remain cautious at best. I know we've got an election on Tuesday. I know that there's expectations that the Republicans will win back one of the houses. I mean, the markets love a split Congress, because then nothing happens and no surprises. I'm also remembering the night that Trump won, and prior to that election, how we heard how bad the market was going to do if Trump won the presidency. So I have a hard time getting too committed based upon news flow. I look at the facts. Here's another fact. Here's some improvement over the last couple of weeks. Stocks above the 200, stocks above the 40 improved. This is a weekly chart, and you can see on the terminal piece, both of them pulled back some. So the market's weakened a bit, and you can see on the 13-week new high, new low, the number of stocks or the percentage of new highs to new lows actually backed off something. This was another sign a week ago that a market inversion was probably interesting. Now, I didn't look at this before, and I'm not sure I want to comment on it, but we've had a divergence for ages on the McClellan oscillator. And this is a weekly chart, and we've got lower lows here, but we actually got higher highs on the oscillator. Maybe that's a good sign. I'm probably overreading. Economic news. Now, the last couple times we've had a Fed report, it was followed by a Powell speech, and if the market traded up, then we had a number of Fed presidents coming out over the next week talking the market back down. Well, this is the week of the Fed governor and president's speeches. Are they going to talk the market up after Powell sort of deflated the bubble? I don't know. But keep in mind that although Monday, Tuesday are not giant news days, you've got a bunch of Fed speaking. On Thursday, we've got CPI. You know, one of these days we're going to see CPI fall. Will this be the day? We know what will happen when we see that. Markets will rally. We also know that even if they rally on that day before the information comes out on the futures, it's the data that matters and not what you see before the data comes out. And I've seen on so many days where the CPI or the PPI are coming, the futures are not correct. And then on Friday, we've got some more Fed speaking and consumer sentiment from my alma mater, University of Michigan. Another busy week of earnings. Earnings have been mixed. Those companies that have perhaps done bad but less bad than people expected have really outperformed. And then you'll look at some companies where their numbers look good and they really crater. And I think it's really the whisper number that we might not be aware of that matters. But, good earnings are being rewarded. And the other thing is we've got a lot of companies that have been around a long time, real companies with earnings and revenue that are starting to get really small PE multiples. And I remember from 2008, 2009, I started collecting those. Capri being one of them. These are companies that, if you see Capri, for example, come out and miss earnings and trade up, that's telling me that I should start looking at that list of stocks that have been beaten down but have revenue and earnings and are getting to mid and low mid single digit PE multiples. Expected moves, this tells you what happened on the week. Last week on Friday, we had a massive up move. Then Monday and Tuesday, this is the previous Friday, not Friday a couple days ago. Then Monday and Tuesday, the markets really didn't do anything. Wednesday, we watched the markets rally into the print. And the initial impression on the FOMC decision was very positive. And then not only did Powell talk it down on Wednesday, Thursday, and interestingly, and I still don't know why, maybe just because it got so far oversold, you can see how far we're beyond the expected move. The markets rallied on Friday across the board. The VIX not showing us that we need to be worried perhaps as the VIX has continued to fall. And then the dollar, we'll look at it in some of the other charts I like to look at, but the dollar has weakened as well, at least on Friday after a big move up earlier in the week. So my thoughts, and this is, if you want to quit the video, this is one of those spots. Markets traded mostly sideways into the Fed report, rallied hard on the Fed announcement, but quickly sold off as Powell made it clear there is no pivot. And I would actually take the argument that there was a even more bearish pivot. Some for reasons not exactly sure, markets rallied to close higher on Friday. But it was the broader markets and not the big FANG stocks. The 2021 rally was driven by 5 stocks, and those 5 stocks are laggards now. Maybe that's a good thing for the long run. Despite the Dow week, the Dow finished off its best month in years. We'll have another busy news week with CPI, claims, sentiment, multiple Fed speeches. We have the midterm elections Tuesday. As I said before, markets like a split government, but let's see what happens. There are a lot of things that can swing this market one way or another, and we are in a very strong seasonal part of the calendar in the presidential cycle. One would not be surprised, I would not be surprised, when I say one, to see a year-end rally starting sometime soon. However, any bullishness that I have is tempered because without seeing a change in the interest rate moves, and with the knowledge that we could have a recession next year, or probably will have a recession, it's got to temper my bullishness. And I leave this here, something that somebody posted on Twitter. I can't remember where I got it, but it's such an important piece. And it just shows you the 2000 to 2002, the 2008 to 2009 bear markets. And yes, they did end. Okay, but notice how many in green bear market rallies we saw: 19%, 21.4, 20.6, 20.8, and then in 2008, 12 and 7, but 18.4, 24.22. So not only do you see frequent bear market rallies, they can be pretty substantial. If you like these videos, by the way, one way to show your appreciation is to come to my live meeting, and I'll put that up again right now because this could be a time when people are going to say, I've spoken long enough. And just to remind everybody, December 4th and 5th in Palm Beach Gardens, which is north of Palm Beach International Airport, HGSIDoc@gmail.com. No, we're not done. Here's my daily site, stocksanddocs.com. I stick mostly to Wealthcharts in this. It's sort of a site that I've done to support those folks that have purchased my scanner in Wealthcharts. All right. So I've done the spreadsheet. I've done the PowerPoint. You know, one of the things that I really like about HGSI is I think it does as good a job or better than any other program at slicing and dicing the strength in the market as well as the industry group rotation. I do this at HGSI. I could do it, and I like doing it in Wealthcharts, especially when I want to do it quickly, shorter period of time during the week. I can do it in other platforms as well, but I don't think anybody does it as good as HGSI. And you'll see at my live meeting that I'll be using all these platforms to show that. So first thing I'm going to go to is it's called the Market Analysis Folders. I'm going to go to Major Markets Plus and hit the Warehouse View. And this is opening up 40 different ETFs or markets that I might want to see what's going on. I can rank these by what's doing the best in the market, and the top-down analysis is sort of a price and volume predominant scoring system. And if we rank it by raw combo, silver and oil come right up to the top. You can see the ARKs, 3 of the 4 worst performing are the ARKs. Bonds performing poorly, then you get more ARKK. So it really tells you that small cap tech is really not doing well. Here's the IBD 50 ETF. You can see it's down it's down 51% since its 52-week highs. But this gives me a sense of what's working. And then what I do, and a lot of the things that I talk about and that I use, because I learned them from Ian Woodward, they're found predominantly in HGSI, although I would love to get them into Wealthcharts. That hasn't happened yet. And I've also got them built into what I do in TradeStation and Thinkorswim. Some of those I will be sharing with attendees at my meeting. All right, so what I liked is very quickly look at the markets. And these are boxes that I put in here to help me, but we'll look at them when we need to. So a couple of things about this chart. Let me make it bigger by killing off the fundies, which I don't care right now. I'm plotting Hindenburg omens here, okay? Now, if you were somebody who was watching the market on your own, and you would have noticed that back here at the end of 2021, I talked about it on my videos frequently, there were a series of Hindenburg omens at the top. Weekly Bongo, Hindenburg omens tells me to get very nervous about this market. Now, a lot of the things that I talk about are in this chart. All right. Here's my price action. We can see how it didn't do much in the beginning of the week. Sold off Wednesday and Thursday. And, perhaps the most remarkable thing about Friday is how you have a bottoming tail. And it wouldn't surprise me, although the futures are negative right now, to see the market trail up for a few days. I still think we're going down to lower lows. We'll talk about that more. Also on this chart, these are those kahunas, which is a percent P change. When they're blue, they're bullish. These here, these greens and reds, are things called eurekas and phoenixes, which are on those spreadsheets, and I'll call them out when they're happening, but they're our equivalent in HGSI speak from Ian of some of the follow-through days. But if I look at this, there's no way to be bullish on this pattern. We are in a downtrend. We fail at the 200 multiple times. We've got the 200 above the 50, above the 17. I see nothing here to like except perhaps some very short-term strength. If I look at the Russell 2000, I see failure at the 200 and we're failing again, and ditto. Nothing here to like except for very short term. If I look at the diamonds, these are a little different, and you notice the diamonds had just had a big run up, but really are they any different? Each time we run up, we fail at the 200. Back here in April and here in August, we failed at the 200 again in late October, early November. And then the NASDAQ, which unfortunately reflects typically the types of stocks that I like to trade, looks like the spiders and the Russell just in a strong downtrend. So is there anything here to get bullish about, I ask you? I don't think so, but it doesn't mean we can't have short-term counter-trend rallies. Now, I mentioned before the IBD 50 ETF. This is an ETF that looks at the various components of the IBD 50. It's managed by in and out based upon what's in the list. And this thing has sold off, you can see in the weekly chart, off the highs of late 2021. We could look at the FANG stocks. Now they had a recent reverse split, but the chart's still the same. From 490 down to 50, I don't need to say anything. That's how bad the FANGs have been. How about biotech? This has been one of the strength areas, and fortunately one that I have a lot of stuff in. This is the first thing I've shown you that's broken above their 200, had a little bit of a bottoming tail after a strong day on Thursday. Remember, the market wasn't strong on Thursday. It improved on Friday. Biotech actually had a big intraday reversal and was actually up on Thursday. Biotech still looks interesting to me. And then I could come down here and I can find semiconductors. And we could see here at semiconductors, maybe some short-term strength, but still in a pretty awful downtrend. I like to look at other things. I like to look at the dollar. And again, pulling back into that blue line, which is the 50. And if the dollar was weak, is gold ready to run? I don't know. I'm not a gold bug by any means, and gold is clearly in a downtrend. But if we can get above the 50 and stay there, that'll be the first time since April. So this is a kahuna, okay? This is a pocket pivot. This is a mobile breakout from a squeeze, and those are my impulse indicators that are in my market MRI and CAT scanner scans that I have in Wealthcharts. So that could be something interesting to watch. And as I mentioned, silver in the short term has outperformed gold, and you could see it had a big gap up here on Friday. So that's something to watch. And so that is how I look in HGSI very quickly at the market from a top-down perspective. Now I flipped here to Wealthcharts, and different platforms, okay? Pros and cons to both. A lot of people look at what I just did in HGSI and say, I don't really want to do that much. I want to be able to open up a platform, not have to run updates. So I use this as well. And here I've got the same thing. I've got the spiders, the Qs, the diamonds, the Russell. And another quote advantage of Wealthcharts is I can go down intraday charts as well. And here's my 200, here's my 50. I've got additional indicators here. The triangle is my EMS signal, which is only available today on Wealthcharts. The circles are what's called wealth signals, which are a signal from Rob Hoffman. Here's 3 time frames of a bongo, and this is my high jump oscillator. So again, what's bullish on any of these indicators, on any of these indexes except for a short term? The using UVXY as my VIX equivalent here. Reversal on Friday, okay, but it was still down 2% on the day. And then I mentioned the dollar. You could see that the US dollar, which has been, excuse me, let's just look at the weekly real quick. How many of your stocks look like this? When someone says cash is a position, they ain't kidding. But you can see on the short term, the dollar is sort of treading water here. It's pulled back into the 50. On the commodities, again, the same thing we just showed you. The dollar stuck its head above the 50. Excuse me, gold stuck its head above the 50. Silver as well. I look at these 200 days as resistance. Oil broke out on Friday, and as I said, natural gas had a decent week, but it's still way down in its pattern. And here you can see the 10-year giving us a doji on Friday, although it was still up 1.5. Let's get that right. It was up 0.8% off of the Thursday close. Now, if we look at the weekly on the 10-year, and I did the wrong thing. I have to remember to highlight the right thing. Highlight this and go to weekly. Notice when interest rates go up, this chart goes up. When interest rates go down, this chart goes down. This is a ratio of value to growth. Rising rates supports value. Falling rates support growth. Part of why I like to watch the weekly on this. So I also have built a timing system I call my weekly timing system. And what I basically have here, again, the spiders, the Qs, the Russell, and the diamonds. I've got candlesticks with a 30 period, or in this case, weekly WMA. I've got my weekly bongos here. I show the same thing every day, every week. I didn't just write this in here. A buy signal occurs when price is above the white line and you have a weekly bongo. We are close on the Russell. We are in a buy signal in this model on the diamonds. We are not anywhere close to a buy signal on the spiders nor the Qs. My guess is that these things will burn out and fall, but right now they're just in a watch zone. All right, so I've spent 30 minutes on the market. You're probably wondering what the heck is wrong with this guy. Nothing. This is how I trade. The market is everything to me. And if you think the market's great right now and you want to go all in, God bless you. I don't. It will be great sometime, and maybe this is the first day of that. I just don't think so. Now, the other super duper strength of HGSI is the industry group analysis. So I've got 176 securities. If I hit warehouse, they move over here. There's my 176 securities. The way I like to rank them, and the first one here is an index. I'm going to kill that one. See if I can do that. All right, hopefully I won't get an index now. No index. Perfect. So now I've got 175. I only look at short-term force, 2-day force, and I see I've got 65 up. I track that every day. 65 is not great, but in a really bad market, you'll have 3 or 4. 2-day force down is only 2. So that tells me when I break it down to the industry group perspective, from a short-term perspective, the market's actually stronger than the indexes suggest. Again, is this a broadening up of the market? And because of that, the major indices are lagging, but the number of stocks going up is higher. I don't know. It's a thought. So what's leading? I like to look at the top 10, and what I do in HGSI, and then I'm going to go over and show you what I do in Wealthcharts, is if I right-click on semiconductors and change to index group, they list the ones, and I like to look at everything that is doing better than the index. So we can look at NVIDIA. So now I'm going to bring down the earnings, and yeah, there's a lot of stuff on this chart. Part of why some people, I don't like my charts. I love my charts. This here is a mobile breakout. I broke above the 50. My John Person buy-sell indicator is still in a sell. The weekly bond goes green, so that means I've turned to a short-term intermediate-term uptrend. Is this a great-looking chart pattern? No, it's in the lower right-hand corner. I want to buy things that are high to go higher, but it's starting to come up off the bottom, so I'm going to put it on a list to watch. And I can look at earnings here and see that it makes money, but there's not any earnings growth. Next one on the list is AMD. So I'm going to go here. And AMD showed a mobile breakout from a squeeze. Kahuna, still John Person weekly sell signal. Yes, it moved up on Friday, and you can see it moved up on Friday 3.5%. I'm going to put that in a watch list too, but these are in the penalty box, not where I want to go. I'm going to right-click to bring this up, left click back. Precious metals are the second. We talked about gold and silver. And gold fields, again, beaten up. Unfortunately, this is where the market is. On a short term, we had a big move up on Friday. Mobile breakup from a squeeze. Weekly bond goes green. A kahuna. Goldfield I put on my watch list. So I right click, quick add to group, and I have a group that I call Buy Watch. And each week I do my own little folder there. And I could go through here. The next was tech. I love this company. I've owned it off and on for a long time. I'd rather buy it above the 200. And then Newmont, again, these are stocks in the penalty box, but are these the best of the bunch? Because the next one is the index. E-commerce discretionary. China suggests that their no COVID policy is going to ease, but look at all these stocks on the weekly. They've been clobbered, and we've had these pull-ups before. Someday Alibaba is going to be a lot more than $80 a share. I just don't know if it doesn't go to 60 first. PDD, this one looks a little bit better. You can see it's started an uptrend on the weekly. But again, the China stocks have so many things going on that you have to be careful. Mercado Libre is more of a South American. I don't like the topping tail. JD.com is their Chinese stock. Big move up. It was up 10%, nearly 10% on Friday. But again, it was news driven. But look at JD.com here. It's got growth rate and revenue. It's got earnings per share growth that's pretty phenomenal and higher than their multiple. So unlike Alibaba, where it's got tepid earnings per share growth and the earnings per share growth is less than their multiple, then something like JD.com looks interesting. Now, I'm not going to go through it all right now, but every day I look at the top 10 groups. Now, I know for a lot of people that's more work than they want to do. That's why I created my scanner in Wealthcharts. So now I'm going to flip to Wealthcharts and continue on my analysis there. I use both of them, okay? People ask, why do I spend a lot of time talking about Wealthcharts? It's simple. I have a tool that I sell for Wealthcharts. So if I'm going to be doing free videos and spending my time teaching people for free, shouldn't I teach them to use things that I actually have an economic interest in? There's the truth, folks. But I use both programs, and I have so much gratitude for George Roberts, who built HGSI, for Ian, who taught me everything, for Ron, who helps to improve it. But I use multiple programs, and let me just talk a little bit about where I put Wealthcharts in. So we've looked at my timing model, and the best I could say is I'm hopeful on the short term, but with that CMI looming in the middle of the week, I'm very cautious on what happens this week. Now, I mentioned rates going up, value. So on the right is a ratio, and this is again one of the really cool things of Wealthcharts is the easiness to plot a ratio of the spider growth versus spider value. When it points up here, growth is in charge. When it points down here, value is in charge. What does this tell you? It tells me value is in charge. Now, over a longer period of time, large caps were really on a roll. They've eased off. If I look at the hourly chart, you can see that small caps, large will be up here, small caps down here, that small caps and value are interesting now. Okay. Another type of ratio chart that I like to look at is the ratio of the S&P sectors to the spider. And what I'm hoping to do is to neutralize the actual numbers and be able to look at where this ratio falls to figure out where the strength is. So I'm really looking for two things. I'm looking for things that are pointing up to this upper right-hand corner. That shows me strength that's been going on for days, weeks. And I'm looking for these long green lines, which tells me, boy, right now I'm getting a big power move. So materials, energy, financials, industrials, staples, healthcare all look really good. Well, if the market's so bad, why are these sectors starting to look good? Well, again, I'm going to go back to the argument that perhaps we're starting to see some of the non-FANG stocks taking the lead and a broadening out of participation, which isn't a bad thing. But when you think about Apple and Microsoft and Google and Facebook, now called Meta, they're a big chunk of the indexes. So the indexes might look worse than this. Now, the defensive plays like utilities, real estate have increased some of late. Discretionary communications still look horrible, and so does technology. Do I think that we can have a bull market without participation of technology? No, although it is nice to see financials and industrials doing well. I can go into the scanners, and now this is where I can do things differently than I do them in HGSI, but I'm really doing the same thing and looking at the same things. First, I'm looking at a heat map of the S&P 500, looking predominantly at the larger components. And we could see on Friday things were incredibly good, except for Tesla, Salesforce, Netflix, United, among others. So it was a strong day Friday. Sector scatter is the way you do top-down in this program. So in HGSI, I rank things by force, which is today's price minus yesterday's price times volume plotted. And then I look at a 2-day or a 5-day or a longer moving average, and that's what I rank by. Here it could be by percent change. And then Rob Hoffman, who's the proprietor of this company, has developed algorithmic scores. So what I might do here is I might go energy, industrials, finance, basic materials, the same things we just talked about on my spider review. If I look at the weekly, what am I missing here? Staples, not the biggest Staples fan. So I've now identified 4 really top sectors. Now I'm going to compare, and you can see I bring up the various industry groups. And let's just do it by algo. And let's take the top groups here. Don't do that to me. All right, so undo this. So I click this one, hit my shift, and go down to here. Okay. And then let's look at the weekly algo and see what I'm missing, fill in the ones that I'm missing. So now I'm trying to identify the top performing industry groups in those top sectors. And then what I do is I hit compare, and that brings me up to stocks. Let's also do them by algo. And let's go down here, and let's go down to say 650 on the algo. And let's put all these into one list. And now I have watch list already preformed. The default one is I want it to be the weekend review, apply, and now I'm going to add to my watch list. And so I've now built a list of the best stocks and the best industry groups in the market. So now we'll come back and play with that. Before I get there, Wealth Scanner is another algorithmic tool, and the higher the score, if you're bullish, the better the performance. And what I put in here is the industry groups to get a sense of what's been outperforming. Oil services, interesting, aerospace and defense, oil production, industrials, short the bonds, commodities, energy, short the Qs. Isn't that interesting? Clearly what we talked about, I think on Thursday, was to start looking perhaps at the contra ETFs if we think the market's going down. But to me, the big power of this program is my scanner. So what I'm going to set the scan to find is I'm going to go into that weekend review list, and I want to find stocks that are at least on a weekly bongo, so they've been in an uptrend on the intermediate time frame. and that within the last 2 weeks, they went from a daily sell to a daily buy. And then I want to find stocks that have now reversed and headed higher that have some of those impulses, the kahunas, the mobile breakouts, the various signals that I like to look at. So here I'm going to set 5 and 500,000 shares. I want only with bullish dots. I don't want bearish dots. And I want that bongo daily to have flipped less than 10 days ago. And then I want to go down here. I want my bongo daily to be bullish right now, my bongo weekly to be bullish. I'm going to hit apply, and then I'm going to rank them by bullish dots. And the strongest stocks in the market, based upon those criteria, are going to come to the top. Now, when you see a bullish new, these stocks are not extended, okay? That's why I've looked for stocks that have reversed in the last 2 weeks. By requiring you to have a weekly bongo, then on the longer time frame, there also has to be some movement up. So AD&T is one, and now I start going through the list and try and understand, are there anything here that looks buyable? And then I can do more analysis. Now, in HGSI, I've taken the market, I've broken it into industry groups. I didn't do it, that's how I use it. And I look at the top stocks and the top industry groups. Here, I've taken the top stocks in the top industry groups and the top sectors, and I put them into one list, and then I'm using the scanner to bring the best things up to the top. So AD&T, don't know anything about it, but what do I see? I see on Friday it had an EMS signal and broke above the 200-day moving average on massive volume. So I've got volume, a breakout in momentum. Look at my relative strength versus the spider and my OBV, the improvement there. So I see a lot that's interesting here. What don't I like? Well, I like the fact it broke above the 200. And I have to go back here to February to see higher highs because there are people that may have bought here that are looking to sell. But this one that could look interesting. I mentioned I like gold here. So here's a gold stock that, what do I like about it? 4 dots, a gap on volume, broke out above recent highs, and has momentum. And you can see the daily and the weekly bongo are green. The daily just switched. The relative strength and OBV have turned up. What don't I like is, boy, is there overhead supply in all these gold stocks. But if you want to play gold, this is one that shows a lot of characteristics that are favorable. This is BCAB, BioAtla. I have no idea what this company does. Big move up, sort of a flag going on for weeks. And is it getting ready to break out of the flag? Was it a squeeze? Had volume, breakup, momentum? I don't know yet, but this is one that's interesting. It's a cheap stock, and I'd want to make sure it has enough volume for me. BHP Billiton, all right, broke out above the 50. All of these stocks have overhead supply, but what do you expect? We've been in a bear market and got the 200 above. So one could start to go through this list and find stocks that are exhibiting bullish tendencies. That's how I use Wealthcharts. Now, during the week, I might just be lazy, and I create a list that I share with Wealthcharts users, and I post it in my YouTube site. And that list will have things, I call it my weekly combo. And it's usually the 600, 700 stocks that I think where the action's going to be for the week. And I pull these out of a number of scans that I do myself, scans that are published in various sites. And, I can turn on the computer. I can go into indices and get a sense of where we are. I could look at my timing system, which prints on Friday, so I don't make much of it until Friday. I could look at what's working now, and then I could go into my scanners. I could look in the Wealth Scanner and get an idea of what industry groups are leading. But I like to run this specific scan, ranking stocks by the number of dots and looking at the ones up at the top. Here's Goldfield, which we looked at under HGSI. And again, big gap up, but it closed at the bottom part, which I don't love. Massive volume, 3 dots, relative strength and OBV in its favor, but like so many, lots of overhead supply. That's how I do it. And I find these two programs to be very complementary of each other. And I'm going to go back to HGSI and make a few more comments on stocks that I'm going to watch this week. So what I do in my process, and sharing more than I need to share, but let me just tell you what I do. I start Friday, and the first thing I do is I run a bunch of scans in TradeStation. I've got some that are in Thinkorswim. I have a number of them that are in HGSI. And then there's a bunch of pre-made scans in HGSI here, as well as things that I'll take out of investors.com, the IBD 50, the weekend review, and so on and so forth. So I have a number of bullish scans. I also, and again, call me anal or whatever you want, I look at a number of different lists of stocks that I get in various places. And what I do is Friday I spend building two lists. One's called Consolidated Buys, which this week had 1,660. And these are any stocks that came into a bullish list. And then I limit it by price and volume. And then I take all the stocks in a bearish list and put it down here. Then I manually in HGSI during the weekend, typically Friday night and Saturday morning before football games, I will look at every one of these charts. Once I narrow this list down, I'll drop them into other platforms and run different tests on them, and then I come up with the stocks that I'm most interested in. This week, there were a huge number of potential buys. Let me say a huge number of potential buys. Most of the potential buys were what I call pullback ready to run or broken out and running. Despite a negative week in the market, all right, and it was a negative week in the market, 5-day performance. So even though we had super strong Friday, it couldn't turn the markets. I'm seeing a lot of green shoots. Now, whether these actually go anywhere, if there's early sign of a year-end rally starting, but let me show you what I mean by a pullback ready to run. A pullback ready to run, it will be a stock that was bullish here. It's had a pretty deep pullback. And then what happened on Friday with Dynavax Technology? It makes money with big earnings growth. I'm not sure if this is reported yet, but the weekly bongo turned green, a mobile breakout from a squeeze, a John Person buy, and a Kahuna. Okay. CTI Biopharma, again, we're in a bear market, but if you look at the weekly, big run up and a pullback, pulled right back to the 200 and had a Kahuna. Some will be better. Here's a beaten down stock, Moderna. Why would I even care about Moderna? Well, look at its multiple. Right, Moderna's cheap now. And yes, its earnings per share growth is tepid at best. And we're out of hopefully stay out of the rah earnings per share growth era of COVID. But Moderna still is a cash cow, prints money, and trades at a multiple of 5. All right, these are all stocks that have pulled back to support and to me are showing some interesting setups. So I like to find these, and then in other programs I might actually set buy stops and others so I can get alerts. The other category that was really big were what I call broken out and running. So ADNT was one of them. And why is it broken out and running? Because here's the stock, it ran up, pulled back here to the 50, here's that Kahuna, the mobile breakout, and then boom, it had a Bible gap up on Friday. It's already broken out. Axosome is one that I've talked about. I actually have a position in it. Pretty big pullback. Now, when I see multiple days of kahunas in a row, I get excited. But something happened with the stock this week, and it gave back some of its Thursday gains on Friday. This one's broken out and running. That's why it's this category. So I build these watch lists. I watch them. Here's another one like GenMab. Again, this is when I get interested. When it's pulled back and moves up off the 50, the thing is running. So I put together these watch lists. I dump them into MarketWatch, into Wealthcharts, and within Wealthcharts I can do lots of manipulation looking at the charts. And I really like my scan. I'll run this on a daily basis, which gives me great insight into what's working now. On that note, I feel like it's the old days. I spoke for 55 minutes. You've probably already clicked off. But in case you haven't, just to call out one more time, I hate begging, so I'm not begging, but I really would like to get to the 15 people sooner than later so I can lock this down. If the reason is airfare, reach out to me. I may have some opportunity for some discount on flying. Got two of them, so the first two that reach out, I'll let you know what it is. But you got to register before I will give you the thing that will get you the discount. But basically, December 4th and 5th, love to see you here. Have an awesome week. Look, I'm not typically Mr. Bear. I'm Mr. Bear right now because I'm still worried about this market. Take care and have a great week.